Coalition Greenwich recording on what's happening in the market. You have Tom Jakes and Subodh Karnik with you today. We are both part of the research-driven consulting team within Coalition Greenwich. Today we want to talk about corporate hedging. Given the changes we're seeing in the market, particularly in terms of the potential for rising rates, what's a corporate to do? So, Subodh, what's going on at the moment in the market?
Tom, thanks a lot. Well, lots going on in the markets. I mean, we are coming off a fairly traumatic period thanks to COVID and some extremely strong actions both from the fiscal side and the monetary side. On the monetary side, obviously, the Fed had unprecedented growth in its balance sheet, has kept rates very low for a fairly long time. And that got coupled with some very strong fiscal action. In the US, we saw multiple programs from the government effectively handing out money to make sure that the economy did not collapse and people's lives weren't disrupted more than they already were being thanks to COVID. All that, as we are hopefully at the back end of the COVID pandemic, and as the economy started picking up and spending picked up, has translated quite rapidly and quite quickly. It has transmitted itself into fairly high inflation prints. By some counts, we are running 6.5–7% annualized. And, obviously that has led to a fairly strong reaction expectation from the Fed. And we have banks like, I'm trying to think now, Bank of America, Harris, these guys are saying potentially 7 hikes this year. There are other economists calling for potentially hikes of 50 basis points at a time. But either which way, the expectation is that Jerome Powell and the Fed will react very strongly to tamp inflation expectations down. And so with that, it's obvious that the curves in play, the front end of the rate curve is going to be significantly higher one way or the other by the time we are in the second half or at the end of this year. And so we have, after a significantly long time, a fair bit of action in the curve and a fair bit of action in the interest rate markets.
You're not concerned this isn't all overblown, and this could just be a transitory phenomenon and we'll go back to the low inflation rate environment that we've seen for many years now?
Ideally, we would like that, coupled with good growth. And in the way I see it, even if it's transitory, it's still going to take some time to work its way out of the system. Now, I don't think we are going to be back in the days of the 1970s. For me, two important points. One, there is fairly strong positive convexity in the energy markets thanks to US shale. So shale wells that were not viable at $60 with oil going through $90 will become viable again. So you will have some supply coming in, and that will hopefully dampen some of these moves on the energy part of the inflation calculation. And I'm a firm believer in the positive convexity of technology and the productivity gains that we have seen thanks to things like the cloud and other advances that have happened. So all that, unlike the 70s, all this now will help the Fed in bringing the curve, bending the curve back down. But that's not going to happen tomorrow. And that's not going to happen, before there will be significant volatility and significant disruptions to the market. And it will most definitely require strong action from the Fed, which it seems to be fairly willing to provide.
Okay, so what's a corporate supposed to do in this situation? Is it too late to take any action?
I don't think so. I think what corporates, first thing they should do is re-engage with their sell side coverage. We've gone through a long period when the only hedging really required was on the foreign exchange side, and there too volatilities have been low. But on the interest rate side, activity has been minimal over the last few years, and for a good cause, a good reason. There wasn't much to do. But now with the rate markets in play, this is the time, first thing, to get in touch with your coverage and start thinking about how to get ready. I mean, we talk to the large sell side banks every day, and you can see them battening down the hatches and getting ready for a higher rate environment in their own way, whether the way they manage their inventories or how they're positioning themselves in the markets, or what kind of skills they are gathering around their various coverage desks. So this is a good time to start thinking about what should we do, how should we do it, and who should we talk to.
Yeah, it's going to be a very different environment for the financial services industry, with potentially risk, but also potentially opportunity. So, what should corporates be thinking about? What if obviously they have debt outstanding, they have assets. How should they be thinking about protecting their shareholders and protecting the value of their companies in this particular environment?
Sure. I mean, the way I look at it, most corporates have, in a very simplistic way, you can look at their exposures as, running the company type stuff, whether it's working capital or short-term borrowings, and that has its own dynamic. And then the regular term issuance that is done through the markets. And, those two things have their own exposures, their own risks, and their own conversations to be had about how to manage, because both will create risks in this environment, and they both need to be managed in their own way to minimize any negative consequences to your income statement and your balance sheet. So that's the first thing. What you have to do is start having, as I said, the conversation with your sell side counterparties. Start discussing your exposures. What do you have actually outstanding? What are your upcoming needs? What kind of issuance calendar are you thinking about? And then think hard about the selection criteria you're going to use to decide who you're going to continue these conversations with. What do your expectations should be set for those counterparties? What do you expect them to deliver back to you? And then get into figuring out the right hedges with them.
I think you're touching on a really, really important point there, Subodh. Counterparty selection is absolutely critical, I think, in this particular market. Obviously, there are many different banks chasing corporates' business. How should corporates go about selecting particular counterparties in this environment?
One thing I can assure you, you will be getting a lot many calls as a corporate now for looking at your interest rate exposures and how to help you hedge than you were, because this, as I said, the sell side has geared up. They know corporates are going to need help to hedge, and you may find banks that you haven't spoken to in years suddenly calling up and saying, how can I help? So, but I'm being a little facetious. No, it's a very good point. Counterparty selection is critical. Look, I mean, there are different considerations to be thought about, and ultimately every corporate has to think through what really works for them. But the way I think about it is, you have your banks that are part of your lending panel, and they have stood by you, lent to you through these markets, and there are corporates that believe that the lending panel should get a crack in the hedging. The lending panel knows the exposures fairly well. They have done deep credit due diligence on the corporate, are familiar with their balance sheet, understand the dynamics of their business. And so there is an argument to be made that they would be the most appropriate counterparty, so to speak, for your interest rate hedging activities.
Sorry to interrupt you, Subodh, but I think we've seen something in our data around this. We've done some work using the feedback we've collected from corporates, and we can see that there really is a linkage between lending and, well, we looked at FX, but we've done a similar study for inflation, interest rate derivatives as well. And so there clearly is that link, but I think people deal with it in different ways. Yeah. So in some cases, you'll see a very high overlap between the two counterparty lists, but then the rankings change. So effectively, what those corporates are telling us is you need to lend, but once you're lending to us, it's anyone's game.
Exactly.
You might win the interest rate derivative, FX, any other hedging business. In other cases, though, those linkages can be really strong. And so I think this is a decision for the treasurer, and there are business decisions to be made around this. Do you want to have a high degree of overlap between your lenders and the banks used for hedging? Are you willing to have some mismatch, because obviously different banks have different skills? And should you be linking lending with the amount of hedging business you give? Personally, I I think there are reasons why you shouldn't, but there may be reasons why you should as well.
Absolutely. And I to be honest, I can see both sides. Yes, you should, well, you may not, because your obligation to your shareholders is to find the best price, and interest rate hedges also are a market product which should trade at the best price. And whether a bank has lent to you may or may not factor into how they price it. And so if they have not, then maybe there is an argument to be made for not connecting those two. On the other hand, a lending bank that has a strong lending relationship with a corporate and has had it over a period of time, as I said earlier, has a deep familiarity with the bank, with the corporate's balance sheet and its credit exposures, and the way the dynamics of its business affect that credit quality. And so there is a possibility of negotiating better credit terms, and that's a selection criteria too. That when you do these hedges, the typical corporate does not sign a CSA. So your credit selection, the credit criteria that the banks are going to offer you, they will factor into your decision on who you will go with. And let me add another complication. Some of what we're talking about in terms of exposures will come from your issuance calendar. And the best banks for DCM and distribution may not be the best banks, or may not be on the panel of your lenders. So then what do you do? Right? Do you do the issuance somewhere and do the hedges somewhere else? Many times the issuance and the hedge are tied together for a better price. So these are all complicated decisions. There are many moving parts here, and I think between your lending panel and the subtlety that you introduce, between the correlation between the lending panels lending to you and the hedging you do versus just using lending as an entry ticket, versus credit terms, versus distribution and DCM for term issuance. All these things are important. Another factor I would add is in these inflection points in the markets where there is significant volatility and uncertainty, you want banks that give you creative ideas. You don't want a bank that just says, what do you want to do? And then I'll give you a price. You want somebody who's going to come to you with, understand your portfolio of exposures and come up with interesting ideas. And that not only, satisfy the need to control those exposures to the extent that you feel comfortable with or have, meet your criteria, but are also creative in terms of pricing, creative in terms of also being able to adjust and unwind. So all these factors come into play.
I think you made a really good point there. And one word you used earlier in our conversation was re-engage. And that's one thing we see in our data, that it's the banks that stay with you, even over the last few years, where the transactions in interest rate derivatives for corporates have been episodic. Those banks that have stuck with their clients, I think, are the ones that will continue to stick with them as the market evolves, as hedges need to be adjusted. And to summarize, I think what you're saying, Subodh, and please tell me if I'm wrong here. One thing we tell the banks that we work with is know your clients.
Absolutely.
I think it should be the other way as well, that if you're a corporate user of financial services, you need to know your banks. Absolutely. You need to know their strengths. Where can you work with them? How do you bring in the best services that you're receiving and ensuring that you're distributing your business in a way that allows you to retain optionality, but ensures that you're a meaningful and good counterparty for your providers? Because it's obviously it's in everyone's interest for these relationships to be healthy and mutually beneficial. And clearly, I think that's what the best actors on both sides want.
Absolutely. And you've made an important point. It's been an episodic market. The last few years have not presented a scenario where corporates needed to be active in this market, which is a good thing, but times are changing. This is the time to call your counterparties, understand their credit postures, understand their balance sheet postures, understand how much they're willing to go out on a limb for you across credit, balance sheet, pricing, how much will they accommodate you during issuance. Get an idea of all that. See who has been providing you with the best ideas. There may be counterparties you haven't spoken to recently, but who you have heard in the market about. You may want to check them out and ask them, look, these are the exposures I have. What do you suggest? just as, I always, I used to, when I covered clients, when I was working on the sell side, I'd always tell my clients, don't just compare price. Put me in the market to compare ideas. Look at my ideas with other people's ideas. Price, anybody can make a price. So ask your counterparties for ideas and see who's come up with the most creative ideas that suit your book. And then, as I said earlier, the Fed's going to do what the Fed's going to do. And, one thing is for sure, they have to wring out inflation from this market and the inflation expectations from this market. So we will see rates moving a fair bit. We will see volatility in the interest rate markets. And so I don't see much of a choice in terms of not doing anything. So the time for action is now. I think the sooner corporates engage with their bank counterparties and start understanding what is the scenario, what is the landscape look like, and what they should be doing, and hear your counterparties out, I think the better it is.
Yeah, I would certainly agree with that. So do you have any final thoughts, Subodh?
I think, just to summarize, don't just go by price, don't just go by size. As we articulated, and as Tom, you mentioned, what our data shows, we are in the market right now with the survey, and we have some fantastic data that's come in. The criteria for counterparty selection are complex. There are many moving parts, and so be thoughtful. Speak to your counterparty sooner than later, and I think the time for action is now.
Thank you very much, and thank you for your time on this. It was a really interesting conversation. And for all of you who've listened to the end, thank you very much for joining us.
Thank you.
Thanks.